Hello and welcome to Portfolio Matters. In today's share talk, we will be discussing the London-listed mining royalty company Anglo-Pacific Group, which has today announced a potentially transformative acquisition. But before we do that, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end.
Thank you, Richard. Now, Richard put me onto this obliquely through his talk on Eli Gold royalties, which was one of our very first share talks, and I will include a link in the description of this video, and I urge you all to go and see that. That is Canadian listed gold royalty company. And included in Richard's presentation was this chart of the performance of gold royalty companies. And I like this. They have had absolutely extraordinary performance. You'll see that the performance is so strong that they've had to use logarithmic scales on the top two charts. So that prompted the question, are there any British mining royalty companies that I can invest in? And the answer is there are a few. And over the course of the next few weeks, I will be looking into them. The first one is Anglo-Pacific Group. So this is the share price. And I think the key takeaway is that since the end of 2019, Anglo-Pacific shares have not recovered, whereas actually all the industrial metals and the coal markets have all recovered. So it seems to me that there is quite a substantial gap between the potential earnings of Anglo-Pacific as they are right now and the share price, which is lagging. So what does Anglo-Pacific do? Well, it's got investments in mining metals, iron ore, copper, vanadium, nickel, cobalt, uranium, gold, silver. But actually, right now, the main source of earnings are metallurgical coal and thermal coal, but that will decrease going forwards. And it makes a big play of moving into battery metals. And today it has announced the transformative acquisition of a stream from a cobalt mine in Canada. And we will go into that. Now, one of the things I find incredibly attractive about these mining royalty groups is that essentially they have very, very few employees. Anglo-Pacific has 11 employees. It's mainly essentially a financing company. So its share price is currently about 136. It's actually down slightly today because they're going to do a share placing, but it has a good yield, has a yield of 6.7% that is well covered by earnings and a P ratio of around 8.2. As we will go through the economics of some of its net smelter royalty and gross royalty revenue streams, you will see that as prices rise, so they get more of the revenue stream. And that means they were very highly geared to the commodity cycle. As the price of the commodity goes up, they not only participate in the increase in the commodity price, but their percentage of the royalty stream also increases. So they're sort of exponentially geared to rising commodity prices. Now, one of the problems is they do have exposure to coal, and that is going to peak in the next 2 years. But if you look at the earnings over the last few years, it has mainly been coal. Now, the other assets have been invested in later and will be an increasing proportion of earnings going forward, and particularly now they've done a transformative deal buying this cobalt stream. You can expect that coal will be declining in future, but right now coal is probably 60 to 70% of earnings. So a few terms that I needed to educate myself on when understanding these mining royalty companies. So GRR is gross revenue royalty, and that entitles Anglo-Pacific to a fixed portion of the gross revenues. So that's really important. That means they get, if it's from a coal mine, they get a portion of the value of the coal sold. It doesn't matter how much it cost the mining company to mine that coal. None of that is relevant. What matters is the price that the coal company got for the coal. All the costs associated with mining the coal do not affect the income of Anglo-Pacific, which is an absolutely extraordinary deal. If you think about, we analyzed Centamin earlier this year, and Centamin have problems with the stability of the mine, and they're having to pay a lot of money to stabilize the mine. None of that would matter to Anglo-Pacific if it had a gross royalty agreement with Centamin. All that would matter is that Centamin have continued to produce the same quantity of gold, say, and the costs involved in getting that gold out would be irrelevant. So these are really extraordinary deals. Now, the net smelter royalty is a similar thing, but it is dependent on the actual metal production from the smelter. Metal streams, and I don't think, looking through the accounts, that there are any at the moment, but metal streams are where there is an agreement. You can buy some of the output of the mine or the smelter at a fixed cost. So Anglo-Pacific, it makes a big play of ESG and how it is moving its assets towards environmentally friendly battery metals. But right now it's got a lot of coal. So over the last few years, it has invested 250 million in the last 6 years, including 75 million in 2019. But then this morning, it announced a 205 million acquisition. So you can see that today's announcement is absolutely transformative compared to all its previous, the size of all its previous investments. In 2019, invested 50 million in the Mantos copper mine in Chile, and it had 1 quarter's worth of revenue in 2020, and this year will be the first full year. So it is moving out of coal and into battery and clean technology metals. And as I've said previously, it has only 11 employees. So these are its assets around the world. You can see its producing assets are 2 Australian coal mines, both producing mainly metallurgical coal. PCI coal is pulverized coal injectable or something, which means it's coal that can be injected into furnaces. It has a uranium asset, vanadium. It is in dispute with the 4 Mile uranium mine in Australia, and we will go into that. That is a negative. And it has some gold, copper, silver, and a big iron ore. which it is monetizing and selling part of in order to fund today's cobalt acquisition. Okay, so earlier when I was talking about how the royalties and the revenue stream to Anglo-Pacific are highly dependent on prices, you can see exactly why from the terms of their agreement with Kestrel. If the price of coking coal is below $100 a ton, they get 3.5% of the value. If it rises above 150, they get 7.5%. So they're very highly geared to rising coal prices. And as of now, the current price of Australian metallurgical coal is $156 a ton, which is 200 Australian dollars a ton. So they are in the 7.5% royalty range. Whereas as we go through the accounts for last year, you see as the price of coal collapsed last year, so the revenues of Anglo-Pacific also took a huge hit. And you'll see a similar arrangement applies to the gold, copper and silver mine. And as the price of gold is above $1,100 a ton, they are getting 3%. Now, one of the things about all of these royalty, mining royalty companies is that a lot of these agreements were done years ago, and the economics were signed when prices were much lower. And that can be good and bad. So you'll see the hurdles for high royalty fees are quite low, but some of the other companies I've looked at also have clauses which allow the mine to buy back the net smelter royalty, these royalty agreements, at quite a low option price. And obviously those option prices looked very high when they were signed 10 years ago, but now they're a bit of a bargain. So that's something to be aware of. Right, so to clarify, PCI coal is pulverized coal for injection. Development assets. There's this calcium carbonate mine, which is really interesting. I wouldn't have thought you could you'd mine calcium carbonate. You can scrape them out of sinks all around the world. Now the Powie nickel and cobalt mine, which is in development, the US government has just invested 20 million into trying to get that mine going, accelerating its development. So the US government is very interested in ensuring security of supply for battery and high-tech metals. And so that's good news. Yeah, that means that hopefully this mine will come into production sooner. Now, Salamanca is the mine that is owned and being developed by Berkeley Energia, which is listed in London. And those of you who know this company or have followed it will know that it is in development hell, as various environmentalists try and hold up the development of the mine. So you should be warned that that is the sort of assets that they are invested in. And these are the early stage, so iron ore, copper, chromite, gold. But frankly, this company has potentially been transformed today by this massive acquisition of a cobalt stream and one of the largest cobalt mines outside of the Congo. So that puts it in a very strong position. Okay, so these are the earnings, and you will see that in 2019, frankly, the vast majority of it was coal. So 11.8 million out of a total of 17.5 in Q1 2019. And obviously, as the coal price collapsed, so its earnings collapsed. The other thing to highlight is the very low contribution from 4 Mile, where they're in dispute. Okay, so we look at Kestrel. The main point about Kestrel is over the next 2 years, the mining company are going to start mining the main areas over which Anglo-Pacific have a royalty agreement. So you will see an increase in the royalties from Kestrel, as well as an increase in the price. So you'll see a surge in the revenue stream from Kestrel to Anglo-Pacific. But then from 22 onwards, those areas will have been mined out, and there will be a 50% drop in the revenues from Kestrel, and that will create a gap, because Kestrel, as we saw from the last table, provide a big chunk of the earnings. Now, this cobalt acquisition, the announcement today was very light on financial details. The 4 Mile dispute. So the 4 Mile is a uranium mine that is managed by Quasar Resources, and Quasar are choosing to interpret their agreement with Anglo-Pacific as a profit sharing agreement rather than a net smelter royalty agreement. So they are subtracting all the production costs, etc. As a result, they are providing a very low revenue stream to Anglo-Pacific. Now, this is in court, but as you can see, this is from the 2019 annual report, and that's at least 18 months old, and I can find no updates. But APF claim they have a good case. So this is the portfolio contributions from the various acquisitions, and you can see that it has been growing over time. And the pre-2014 acquisitions currently make up a big chunk of earnings, and the post-2014 growing, but that will change as Kestrel peaks soon. So I find these charts slightly misleading in that what Anglo-Pacific are trying to do is to convince us that their exposure to coking coal and thermal coal is massively declining. So you see in 2013, coking coal was 76% of their portfolio, and they are saying that it is now 21%, and thermal coal is another 15%, so in total 36%. However, these charts are based on the book value. They don't relate to the actual earnings received by the company now, whereas if you looked at just the earnings in, I expect, 2021, I think you're going to see that coking coal is probably about 70% of earnings. Actually, we don't know what the terms are for the cobalt acquisition, and the copper mine they acquired in 2019 will have its first full year, but certainly coal will be much more substantial part of the mix than 36% before it starts declining in 2022. So if it acquires the calcium carbonate project and the cobalt nickel mine in Brazil, then this is what its commodity exposure would look like. So coking coal and thermal coal would fall to 29%. But frankly, this is already out of date. This is from half one 2020. And this needs to be updated based on their transformative deal today to buy the cobalt stream. And here you'll see that they are showing that the Kestrel's contribution to Anglo-Pacific, i.e. coal's contribution, is reducing. So Kestrel's coking coal, Narrabri is thermal coal, and they're both declining. This is the financial performance, growing dividends, well covered, which they have kept on paying throughout 2020, despite the fall in their earnings. You see that their earnings did take a substantial hit in 2020. Okay, so one of the questions going through the economics of these mining royalty companies was, given the very favorable economics of getting 2% of the gross revenue from a mine before costs, why are mine owners signing these deals, which just seem extraordinarily positive for them? The mining royalty company? And the answer is that the mining royalty companies provide very early financing, and they receive nothing on that investment until the mine is in operation. Whereas if you were to try and finance the mine with debt, you would accrue, let's say, 5 to 8 years of interest before the mine started up operations. And also, if the mine is a failure or is less successful than anticipated, then the mining royalty company participates in that value reduction, whereas debt would not. Okay, so today's news. And I should say that I've been working on this presentation for the last couple of weeks. So it was rather timely that they announced this transformative deal this morning. So Voisey Bay is an established copper nickel cobalt mine in Canada operated by Vale. And it's one of the largest cobalt producers outside the DRC, and hence is an ESG friendly producer of cobalt with security of supply. Now, this announcement is rather light on details. So Anglo-Pacific have acquired a holding company that holds a 70% interest in the cobalt stream. And they've acquired it from an unnamed private equity company for 205 million plus contingent 27 million going forward. And there are full details of that in the announcement if you want to look it up. The acquisition will be funded via an equity placing, which will be less than 20% of the outstanding capital, the monetization of their iron ore stream, and part use of the 180 million revolving credit facility. Now, shares are available to retail investors to participate in the share placing via primary bid. And I've had a look, and the bottom line is that the share price will be determined by institutions, and then private investors will get to participate at that price. But we don't know what the price is yet, so we have no idea whether it's a bargain or not. Now, they're now saying that the deal will mean 61% of pro forma royalty will be from battery-related materials, and substantially reduces the company's exposure to coal. Now, if we go back up to the producing assets, you'll see that which ones are battery related. I think the only ones you could say are copper, vanadium, and some copper from the EVBC. So you would have to say that, and as we know that these are relatively small proportion of earnings so far, you have to say that the new acquisition will constitute a big chunk of future earnings. Now, the Mantos Blancos will have its first full year this year, but that means that looking at the historic earnings are not a very good guide for what this company is going to be going forward, because that should be transformative. And all the company will say is it's immediately earnings accretive. It doesn't tell you how much cobalt they're expecting to get, etc., etc. But the cobalt price is going through the roof. So I don't know when they started, researching this deal and doing the terms, but it's quite a good time to announce it.
Yeah.
Historic results, but frankly, we're not going to go through these because I don't think they're very useful now. I mean, we need to take a bit of a leap of faith with how this company is going to develop going forward. I mean, they are obviously doing deals and growing their revenue streams. These are the numbers from Stockopedia, and frankly, I don't know what they're smoking on 2021. That is going to be big. It's going to be bigger than, clearly much bigger than 2019, just based on the thermal coal alone. So positives. It's a diversified pure mining play, and as we've seen, it doesn't actually care about the execution risk of actual mining. As long as the mine is churning out stuff, it takes a stream of that. The shares are on a P ratio of 8 times. Sorry, that's not what that says. The earnings have grown 8-fold over the last 5 years, but actually the shares are cheap. They are also on a P ratio of only about 8. And as we've seen, it has a very highly geared exposure to rising commodity prices. It's paying dividends and buying back shares. It's on the lookout for acquisitions, and as we've seen today, it's made a big one. And the shares are subdued compared to rising metal prices. Negatives. Coal is currently a big chunk of earnings. And I mean, this 40% in royalty income drop in 2019, that is going to be completely reversed now by rising metal prices and coal prices. And one of my concerns, this drop off in mine volumes from Kestrel, has been partly answered by today's acquisition. There is the 4 Mile dispute, which is unresolved and ongoing, and the McLean Lake uranium mine has gone back into care and maintenance. So in summary, I really like this. I mean, it's only got 11 employees, it's got a growing revenue stream. It's moving into battery metals. I think these shares are cheap. I bought a load. End of story.
Well, thank you very much, Keith. It's a really interesting presentation. And I think you and I both like these. We like good quality mining royalty companies because of the way that year after year they are able to grow their earnings. Now, the question for this company, I guess, is can it actually deliver on a continuing growth of earnings with the changes that are currently ongoing in its portfolio? And if it can, it would be a great long-term investment. And at a PE of 8 and a dividend yield of nearly 7%, it's one that one might want to tuck away for 5 or 10 years.
Absolutely. And clearly the company management are very actively looking to replace the coal stream, and they're growing this business. And as we've seen from the first chart, Richard, which came from your presentation, I mean, these are just absolutely extraordinary investments on the long term as their early stage investments start to be realized. Yeah. So in the case of Anglo-Pacific, they have The copper mine, they invested in 2019. This will be the first full year. They've just bought this cobalt stream. And then they've got the Brazilian nickel coming on. So I think there's potentially a lot of growth in the portfolio, and you get it at a P/E ratio of 8 and a dividend yield of 6.7. What's not to love?
I agree. I also think that although the amount of coal in the portfolio is going to be declining, the metallurgical coal is going to be important for many years to come in steel manufacture, and steel manufacturing is not going to go away.
Yeah.
Good. Well, thank you very much for that, Keith.
Welcome. So I hope you enjoyed that, and you will press like and subscribe to our channel. I will be doing some more of these over the next few weeks, looking at Altus Strategies, Trident Royalties, and Metal Tiger. But all remains to say is thank you from Richard Wheater.
And goodbye from Keith Jordan.
Goodbye.
Goodbye. Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal, or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.